What if the growth story you've been told about Southeast Asia is only the first chapter, and the real test is whether the balance sheet survives long enough to write the rest? Welcome to SEA Weekly. I'm Emily Chen, and this is your weekly guide to the most significant developments reshaping Southeast Asia's digital economy and industrial landscape.
Thanks for having me, Emily. The headline for this week is one I think will age well. The balance sheet is the story. In the same 48-hour window, Indonesia intervened to support the rupiah. Thailand reported a US $7.6 billion current account deficit for April, and Singapore commodity traders were already describing active rerouting decisions driven by Middle East disruptions. Individually, any one of these is notable. Together, they signal something structural.
And what makes this week's read sharper than usual is that it sits on top of a thesis we've been building for several weeks, from the corridor and the cap, through capital without capture, and last week's rails, refinery, and real margin. The absorption question is no longer theoretical.
Exactly. ASEAN is still building industrial capacity and digital infrastructure. That continued clearly this week. But the decisive contest has shifted. It is no longer about attracting the most capital. It is about who can carry volatility on their balance sheet while still compounding capability.
We'll start with the macro signals and the uncomfortable policy geometry they create. Then look at where construction is still accelerating despite the pressure. And then Chloe joins us to close on what all of this means for payment infrastructure and fintech positioning. Let's start. Okay, Miguel, let's start with the most immediate signal this week, which is the FX interventions. Indonesia on Friday, India at roughly the same time. What were you watching for there?
Yeah, so the rupiah story's actually a bit of a tell. You have a central bank intervening, which isn't surprising given the backdrop, but even with support operations, the currency still weakened, closed down about 0.5% despite active management. And that's a meaningful data point. It means the shock was faster than the buffer.
The shock being oil prices? Because I understand this was tied to the US-Iran situation.
Right, so the underlying driver was higher oil prices, linked to what sources describe as the US-led military campaign against Iran. Energy price spikes transmit very quickly into import costs for current account deficit economies. Indonesia is a net importer of refined fuel, so the rupiah feels it almost immediately. There's very little lag.
And then Thailand the same week, $7.6 billion current account deficit for April. That number stopped me.
It should stop you. April, seasonally, is not Thailand's worst month. You have some tourism contribution, you have decent export activity, and yet the external balance was deeply negative. The central bank's own commentary pointed to weaker than expected tourist spending and higher pass-through of fuel costs on the import side.
So you've got a demand shortfall, tourism underperforming, and a cost spike, energy prices rising, both hitting at once?
Exactly. And here's where it gets uncomfortable, right? A KKP economist, Pipat Luengnarumichai, went on record this week warning that Thailand could drift into a dual deficit configuration, meaning simultaneously running a fiscal deficit and a current account deficit.
Which is, help me flag this correctly, that's a warning sign for currency markets specifically, right? Because you're now funding two gaps from external sources.
You're funding both gaps externally. Dual deficit economies are structurally more exposed to sentiment shifts. The baht was already under some pressure, and this adds a medium-term narrative that FX market participants can anchor to. Pipat was clear. If both deficits persist, you could see more sustained baht weakness. Not a crisis, but a grind.
And the Bank of Thailand's response to all of this? Because I saw the reporting said they would likely hold rates, which seems counterintuitive given everything you just described.
That's the uncomfortable policy geometry I keep coming back to. Inflation in Thailand is relatively subdued compared to regional peers, so the traditional trigger for tightening, consumer price acceleration, isn't there. But you also have currency pressure and an external account that's deteriorating. Raising rates might help the baht, but it dampens domestic demand when you're already seeing tourism weakness. Not raising rates might give you more currency pass-through on imported costs.
So they're basically stuck. No clean move.
No clean move. And what I think is worth underlining is that markets sometimes read no rate hike as everything is fine. It isn't. No rate hike needed is not the same as no stress present. Those are different sentences, and conflating them it's a pretty common mistake right now.
That distinction gets lost constantly. The rate decision tells you about inflation management. It doesn't necessarily tell you about balance of payments health.
Correct. And Indonesia's intervention reinforces that point. The market is testing these currencies in real time. High-frequency external shocks, oil linked to geopolitics, commodity prices moving on Middle East disruptions, are now arriving faster than the cadence of macro policy adjustments. The old playbook assumed central banks had a few weeks of data before they needed to respond. That lag is compressing.
Which is your central thesis for this week. The old playbook is too slow.
Too slow and too narrow. The old playbook treated FX pressure, current account dynamics, and commodity logistics as separate risk buckets. They used to behave separately. They don't anymore. They interact in real time, and they interact specifically on the balance sheet of any company or economy participating in regional trade. That's the hard part. It's not macro abstraction. It's a working capital problem that hits your treasury on a Tuesday.
Okay, so that's the stress case. The question I want to get to is ASEAN bunkering down, or is something else happening simultaneously?
Something else is absolutely happening. And honestly, this was the most interesting part of the week to me. Because at the exact same time as all this macro stress, ASEAN was still on offense industrially. Let's go there.
So the wrong conclusion from everything you just laid out would be to say ASEAN has shifted into defensive crouch, and you don't buy that.
No, not even close. Let's take Vietnam as the case study, because Vietnam had an unusually dense week industrially.
Walk me through it.
Okay, first, Vietnam-Singapore industrial parks. The VSIP network announced 4 additional parks during President To Lam's Singapore visit, bringing the total to 26. And this isn't just a ribbon-cutting event. They also announced an advanced manufacturing research center as part of the bilateral deliverables. That's a qualitative upgrade. Research infrastructure alongside industrial footprint.
And the VSIP network is, just for context, that's a long-running bilateral framework between Vietnam and Singapore?
Exactly. It's been operating since the 90s, but it's been accelerating meaningfully. 26 parks is significant scale. And the policy signal embedded in the research center is that Vietnam is trying to pull technology transfer and knowledge into the relationship, not just lease industrial land at a premium.
Which connects directly to the Gulf energy story, because that also had a technology transfer condition attached to it.
Right. During the same visit period, Vietnam's president invited Gulf development to expand energy investments in the country. But the framing was explicit. Vietnam wants technology transfer, workforce training, capability building. The country is actively steering investment toward terms that build local depth, not just land equity or royalty flows.
So it's conditionality on capital inflows. You get access, but you're expected to leave capability behind.
That's exactly the model. And this is consistent with a broader regional industrial policy arc we've been tracking. Capital without capture was about precisely this. The question is always, who owns the margin after the initial investment cycle ends?
Now, the steel number, I want to make sure we give that proper weight. 2.1 million tons of crude steel in April, entering the global top 10 for the first time. That's not a minor milestone.
It's not a vanity metric, no. January to April, Vietnam produced 8.5 million tons, up about 8.4% year-on-year. The top 10 entry is significant because crude steel production is a proxy for heavy industrial depth. It means you have blast furnace scale, energy supply reliability, and raw material procurement networks that function under pressure. These are the same capabilities that underpin industrial park competitiveness long-term.
You're not just assembling consumer electronics, you're producing materials that go into construction, logistics infrastructure, and potentially defense-adjacent manufacturing.
It's a fundamentally different tier of industrial capability.
Fundamentally different. Assembly is low barrier. You can move it relatively quickly as incentive structures change. Steelmaking requires sustained capital investment and operational discipline at scale. The fact that Vietnam got there, it changes how I model the country's industrial trajectory over the next decade.
And then Fraser's property, the $343 million European logistics sale. How does that fit into this picture? At first glance, that's a Thai conglomerate selling European assets. What does that tell us about ASEAN?
Yeah, the headline looks like it doesn't belong in this conversation, but the strategic read is actually quite clean. Fraser's property, which is the asset platform of Charon's TCC group, sold 4 European logistics properties to free up capital. In a high-volatility, high-interest rate environment, rotating out of lower-yielding European logistics and redeploying into higher-return APAC positions is exactly the kind of balance sheet discipline you want to see from a regional conglomerate.
Liquidity management in real time.
Active capital rotation. It's the opposite of passively waiting for calmer markets. And, this is important, it implies the management team has a forward view on where the next cycle is, and they're moving ahead of it rather than reacting to it.
So if I'm synthesizing what we've seen across these macro and industrial segments, you have currency stress and external account pressure on one side, and on the other side, VSIP expansion, technology transfer conditions on energy deals, Vietnam reaching a steel milestone, and deliberate capital rotation. How do you hold both of those simultaneously?
You hold them by accepting that they're not contradictory. They're the same story. The countries and companies under the most pressure are also the ones most actively building for the next cycle. The stress is the condition that separates who can keep compounding from who cannot. That's what I mean by balance sheet depth as the actual contest.
And ASEAN, by your read, is passing that test so far.
Passing it, but not easily, and not uniformly. Singapore's position is very different from Thailand's, which is different from Vietnam's, which is different from Indonesia's. But the pattern of continued offensive investment alongside macro stress, that's broadly ASEAN's mode right now, and it's remarkable to watch.
I want to bring in Chloe next because she's been watching the fintech and payment infrastructure side of this week, and what she has to say about Coda payments and C's AI repositioning actually rhymes with what we've been discussing on the industrial side. Chloe, welcome back to the conversation. Miguel's been laying out a week where macro stress and industrial acceleration are happening simultaneously. You've been watching the payment infrastructure side. What's your read?
Yeah, and honestly, the thing that struck me most this week was how well the fintech story rhymes with what Miguel described on the industrial side. The exact same week all that FX pressure is happening, Coda Payments secured its MAS major payment institution license. And I know a licensing announcement sounds procedural, but I think people seriously underweight what this actually means.
Give me the practical translation. What does a major payment institution license actually unlock?
So the MPI license under MAS covers merchant acquisition and domestic and cross-border transfer services. For Coda specifically, which is GIC-backed and has been operating in gaming payments and digital content across Southeast Asia, this is the regulatory infrastructure that lets you build durable, scalable cross-border monetization. You can acquire merchants, you can settle cross-border flows, you can operate at institutional grade. That's a fundamentally different standing than a standard payment service provider.
And why does that matter specifically now, in this week's context?
Because, okay, here's the thing. Everyone in fintech for the past 5 years has been pitching adoption as strategy. User growth, GMV, app downloads, and those numbers are real, they matter. But in 2026, the margin in payments sits in the plumbing, not the interface. Who owns the merchant relationship? Who runs the cross-border compliance stack? Who has the regulatory standing to touch settlement flows?
And Coda's answer is us, because we have the license.
Exactly. The license is proof that you've invested in the hard, boring compliance-grade infrastructure. And boring infrastructure is exactly what survives macro volatility. It doesn't care whether the rupiah is having a bad week, the rails keep running.
That is a genuinely useful reframe. Fintech resilience as infrastructure depth, not app resilience.
Right. And the CAI team's story points in the same direction, just from a different angle. C, one of the most mature digital platforms in the region, set up a dedicated AI investment team as part of its pivot beyond core e-commerce. And my read on that is, mature platforms don't invest in AI because it's fashionable. They invest because organic GMV growth no longer clears the internal return bar on its own. You have to drive efficiency, data leverage, and capability unlocks.
So it's not an AI enthusiasm story, it's a capital reallocation story.
Capital reallocation, yes. The easy growth phase is over for the big platforms. C knows that. The AI investment team is about finding the next marginal return, which is probably supply chain efficiency, fraud detection, personalization at the merchant layer, and payments intelligence. Same playbook, harder game.
And how does this connect to the balance sheet thesis that Miguel was building?
Directly. The fintechs and payment platforms that are going to matter in 3 years are the ones that built the boring stuff while everyone else was competing on user acquisition, cross-border compliance, merchant data, settlement reliability. These are balance sheet decisions dressed up in product roadmaps. And in a region where FX volatility is real and working capital pressure is real, as we saw this week, having a regulated, reliable payment rail is not a nice-to-have. It's a survival asset. Distribution is table stakes. The moat is infrastructure plus risk management. That's exactly it. And the week of KKP dual deficit warnings and rupiah intervention is actually a useful reminder of what the moat is for. It's not just a competitive advantage in calm markets, it's load-bearing when markets aren't calm.
I want to bring that back to Miguel to close the loop on the macro picture, because there's still one piece we haven't touched: commodity rerouting, the Shangri-La dialogue signals, and 3 indicators worth watching coming out of this week. Miguel, welcome back. Before the 3 watch indicators, I want to make sure we give the commodity rerouting story proper weight, because it appeared almost as a footnote this week, and I think it's carrying more than the headline suggests.
Yeah, I'm glad you flagged it. The Business Times ran a piece on Singapore commodity traders, firms like Vital, describing how they're actively rerouting procurement because of Middle East disruptions. Oil, coffee beans, other soft commodities. And these aren't distressed traders' stories. These are well-capitalized commodity desks doing exactly what they're built to do, finding alternative supply routes when the primary route is disrupted.
And Singapore's role in that is, it's not incidental?
No, it's structural. Singapore as a commodity trading hub, specifically with deep trade finance, storage, and logistics infrastructure, is functioning as a regional buffer. When Middle East disruptions hit, Singapore-based intermediaries can absorb, reroute, and resupply faster than anyone else nearby. That capability has been built over decades, but the current environment it's stress testing it, and so far it's holding.
Which ties directly into the Shangri-La dialogue this week. ASEAN defense ministers reaffirming commitment to the free flow of trade through international corridors. What did you take from that?
So, and I want to be careful here, because it's easy to read that kind of communiqué as purely diplomatic boilerplate, but the economic content is real. When defense ministers use language around trade corridor security, they're signaling to investors, shipping companies, and commodity buyers that these lanes are protected. And in a week when Singapore traders are already rerouting because of supply disruption, that signal has a direct economic function.
It's not just diplomacy, it's market signaling.
It is market signaling. Trade route security, shipping continuity, trade finance, payment reliability, those now sit on one strategic stack. And Shangri-La being the venue where ASEAN ministers make that commitment is not coincidental. It's designed to be heard by the financial and corporate community, not just foreign ministries.
Okay, so let me try to put the full picture together and then walk me through the 3 watch indicators. What Chloe said about payment rails being load-bearing in volatile markets, and what you've been describing about commodity rerouting and corridor security, they're both making the same point, right? Resilience has been repriced.
Yeah, and that's the most important development of the week. It's not obvious because it doesn't show up in any single data point. But ask any of these questions. Who can absorb oil-linked FX volatility without forcing disorderly pass-through?
Who can keep trade corridors functioning when geopolitical risk rises? Who can fund inventory, payments, and settlement reliability through a dislocation window?
And the ASEAN systems that can answer those questions credibly?
Will attract the next wave of investment on better terms, not just survive, attract. Because what global capital is looking for now isn't just return potential, it's return potential with demonstrable shock absorption. Resilience is a pull factor.
That's a genuinely important reframe. Okay, 3 watch indicators.
First, external balance persistence. Does Thailand's current account pressure turn out to be an April blip, or does it broaden in May and June into a more persistent funding concern? If May data confirms the pattern, the dual deficit narrative gets real traction in FX markets, not just in domestic commentary.
Second,
Shock transmission speed. Whether further commodity volatility from Middle East disruptions keeps forcing ad hoc FX intervention in regional markets. If we see another intervention round from Bank Indonesia in the next 2 weeks, that tells you the buffer is thin and the old playbook is actively failing.
and third,
Capability conversion, the hardest one to track. Whether the industrial expansion announcements we saw this week, VSIP parks, energy investment deals, Vietnam steel scale, actually translate into local productivity gains and supplier depth, or whether they remain as gross flow metrics, which are easy to count but don't capture who's actually winning the margin.
And the gap between gross flows and capability capture is exactly what the whole capital without capture arc was about.
Which is why I think this week's data is very consistent with the 3-week thesis we've been building. The stress is arriving faster, the building is still happening, the winners will be whoever can hold both, and not just hold them, but compound through them.
ASEAN is still a growth region, but the balance sheet is the story.
The balance sheet is the story.
That's a wrap on this week's SEA Weekly. The thesis is clear. ASEAN is not retreating from ambition, but the test of that ambition has changed. It is no longer measured by how many deals are announced. It is measured by who can absorb FX pressure, working capital stress, and logistics disruption without losing the thread of long-term capability building.
And from a fintech and payments perspective, the same principle holds. The regulated infrastructure, the boring rails, the compliance stacks, the merchant relationships, those are the institutions that carry value through volatility. This week's Coda Payments milestone and C's AI reallocation are both examples of that discipline in action.
The full article, The Balance Sheet is the Story, is on SEA Weekly at cweekly.com. The link is in the show notes. If you found this episode useful, subscribe on Spotify, Apple Podcasts, or via our LinkedIn newsletter. And if you work in ASEAN or invest here, share it with someone who should be thinking about shock absorption, not just growth metrics.
Thank you to Miguel Santos for leading this week's analysis, and thank you for listening to SEA Weekly.
I'm Emily Chen. Until next week, stay analytical.
Oh.